and welcome to the Hanson Bridgett Tax and Cooking Network. My name is Christopher Karachale, and given my knowledge of tax law as well as food preparation, I am the perfect person to provide you with information about the valuable exclusion contained in Section 1202 of the Internal Revenue Code, the exclusion from gain for the sale of qualified small business stock. Section 1202 allows employees as well as investors of small companies to exclude up to 100% of the gain when they sell their shares. Who could think of a more appetizing dish than that? However, in order to get the exclusion, you have to follow a complicated recipe. If this dish turns out correctly, the investor or employee of a small business should be able to exclude up to 100% of the gain on $10 million worth of stock. Pretty tasty, no? Section 1202C provides the starting ingredients for qualified small business stock. A non-corporate taxpayer, that is an individual or a partnership, needs to be issued shares of a C corporation, not an LLC or an S corporation, at original issuance in exchange for money or compensation for services. What this means in practice is that the individual needs to receive the shares directly from the corporation. If the individual buys shares from another owner of QSBS, the exclusion will generally be lost. One final point: stock acquired through the exercise of options, warrants, or the conversion of convertible debt can be QSBS, but it is only QSBS at the time of exercise or conversion. Okay, so the basic ingredient for the exclusion is C corporation stock. However, for the exclusion to apply, that stock needs to be stock in a qualified small business. This is where you really have to follow the recipe. There are two basic requirements to ensure that the corporation is a qualified small business: the gross assets test and the active business test. The gross assets test is relatively straightforward. At the time the shares are received, the gross assets of the corporation cannot exceed $50 million. Now, if the value of the corporation exceeds $50 million after the shares are received, that's fine. It's just that at the time the shares are issued, the company cannot be worth more than $50 million. The active trader business test requires that a small business dedicate at least 80% of its assets to the active conduct of a qualified trader business. What is a qualified trader business? With its usual clarity, the Internal Revenue Code defines these terms by exclusion. Section 1202E3 states that a qualified trader business is anything other than the performance of services in the field of health, law, engineering, architecture, accounting, and any other trader business where the principal asset of the business is the skill or reputation on one or more of the employees. Interestingly, Section 1202E3 states that restaurants are not qualified trades or businesses. That means if we here at the Hanson Bridgett Tax and Cooking Network were the C corporation, we couldn't get the exclusion.
We should look into that.
Wait, now we're cooking and you've got the basic recipe. A non-corporate owner of C corporation stock received at original issuance, and a corporation that meets the gross assets test and the active business test. Once these requirements are met, the shareholder should be able to exclude up to 100% of the gain on the sale of that stock once he's held it for more than 5 years. However, there are some subtle garnishes that make this QSBS recipe even more appetizing. First, while the exclusion generally only applies to stock received at original issuance, tax-free transfers generally won't taint the QSBS exclusion. So, for example, where QSBS is transferred by gift or at death, the transferee generally steps into the shoes of the transferor and is treated as having received those shares at original issuance. The transferee also is allowed to tack his or her holding period to the original transferor. In the tax-free reorganization context, the QSBS exclusion can also be preserved. Let's say you own shares of QSBS worth $1 million, and instead of selling them, you engage in a tax-free reorganization with some large corporation, say Google. In exchange for your $1 million of QSBS shares, you receive $1 million worth of Google stock. Now, even though the Google stock is not QSBS, you should be able to apply the QSBS exclusion to that portion of the Google shares that correspond to original QSBS. So, let's say you sell the Google shares for $2 million in 2 years. Your original QSBS was worth $1 million. On the sale of that $2 million worth of Google, you should be able to exclude up to $1 million based on the QSBS exclusion for those original shares, even though Google itself is not QSBS. That's pretty spicy, no? So now we've put together all the ingredients for our qualified small business dish. It's time to cook it. As we've described, the cooking time is 5 years. However, Section 1202B provides that once that stock has been held for 5 years, taxpayers can exclude the greater of $10 million of gain or 10 times the shareholder's basis in the stock. Now, the exclusion has changed as Section 1202 has evolved. As originally drafted, Section 1202 allowed a shareholder to exclude 50% of $10 million of gain or 10 times the shareholder's basis. In 2009 and 10, the exclusion increased to 75%. However, for shares received after September 28, 2010, the exclusion is now 100%, provided the 5-year holding period is met. So, provided you purchase your shares of qualified small business stock on or after September 28, 2010, and have held those shares for 5 years, you should be able to avoid all tax on up to $10 million of gain or 10 times your basis. Hard to think of something tastier than that. One final point. We've got a special treat for dessert today. Previously, the 100% exclusion was subject to sunsets. Each year, Congress had to renew the 100% exclusion. However, on December 18, 2015, President Obama signed into law the Protecting Americans from Tax Hikes Act, which made the exclusion permanent. That's awfully sweet. Please come back and visit our kitchen again.